Attention! This video is intended for the purpose of educating and understanding the forex market. It is not created to induce investment. Investment is risky. Therefore, investors should study information before making an investment decision. Hello everyone, welcome back to our third chapter. In this chapter, we're going to learn about some terms in forex market, which is we have to know more and what we need to know in forex trading. Are you ready? So let's go. In this chapter, we're going to learn some technical terms in forex market, which is about bid, ask, spread, pip, point, lot, leverage, financial status, take profit, stop loss, stop out, swap, and volatility. Let's start with the first technical terms here, which is about bid, ask, and spread. Bid price is the selling price offered by the broker for the openings of a sale order. Bid price is located on the left-hand side of each currency pair. Ask price is the purchase price offered by the broker for the openings of a buy order. Ask price is located on the right-hand side of each currency pair. Spread. Spread are the difference between bid and ask prices. In the forex market, ask prices are always higher than bid. When an investor opens an order, either buy or sell, it will be negative immediately. It is the service charge fees at spreads are the only cost of investor. This is why it is important. If investors choose broker with low spreads, they will make them more profitable. Let's move to the next technical term, which is about pip and point. Pips come from the word price interest point, referring to the standard units for measuring the amount of movements or changes in currency values in the forex market. And there's one more unit used called point. Point is the last digit of the decimal. 1 pip is equal to 10 points. Let's take a look in the example of determining spread. According to the example of Euro versus US dollar, the bid price is 1.12243, whereas ask price is 1.12253. When taking these two prices apart, the value is 0.000010. This means that in point units, the movement is equal to 10 points. In pip units, the movement is equal to 1 pip. Let's move on to the next term, which is about lot. The meanings of the lot refers to the size of the purchase or sales contract that the investor wants to open the purchase or sale order. The size of the lot is an indicator of the profits or loss based on the value of the lot that the investor opens the standard lot. The standard lot here is used for one lot trading unit, which is equal to 100,000 US dollar. Leverage is to give investor more leverage to open trading contracts that several times higher than the amount of capital. Investors should not choose a leverage that exceeds 1 to 500. This will pose a high capital risk. For example, a 1 to 100 leverage means that if an investor deposits $100, a contract can be opened for 100 multiplied by $100. This means that investor can trade in a $10,000. Let's move on to the next terms in financial status. Balance is the deposit funds unrealized amounts in open order which can take profits or loss. Equity, the total updates from the addition, subtract profits or loss of an open order. Margin is the funds used to place insurance to open trading orders. Free margins is the remaining margined amount which can be used to open orders. Margin level is a data that tells how many percentages margin is left. Let's move to the terms of take profit, stop loss, and stop out. Let's get started with the first one, take profit. Take profit is the part of profitability on the graph line, usually divided by the number of pips or in percentages of number of investor funds. When the chart reaches the take profit point or TP, then the order closes and the investor receives a profit immediately. Let's move to the next terms. It's about stop loss. It's an order that allows an investor to manage risk by ordering a stop loss to terminate or close the investor position when the trading loss reaches a certain price level. Stop loss is the price at which investors decide for themselves that their analysis is the wrong way to reduce losses even more. Next, stop out is when the margin level of investor is lower than being able to maintain an open order position. Then the brokers will let investors close orders, or when the amount of investor money has in that account is less than stop out percentage of the total used margin. Brokers will force investors to close their holding orders. Next term is about swap and volatility. Swap is the fees that investors have to pay when trading overnight. It is the difference in overnight interest rate. Swap values are either debit or credit. They will be both in positive and negative values. Volatility is the value of volatility in the market. This is important because most investors prefer to trade during market movement, which can profit from volatility. If volatility is low, there will be no profit point for investors. Or you can have it here in our service and products, Trading with Neowin FX. Contact us for more at neowinfx.com or just scan our QR code right in front of you. We are here to assist you anytime.